AIM-listed onshore oil and gas exploration company Egdon Resources has just reported earnings. Although being a company mostly occupied with its exploration business, the focus remains on the value catalysts for investors from this point on. Let's catch up now with Managing Director Mark Abbott. Mark, welcome. I said you're onshore, I think predominantly onshore, aren't you? You do have a bit of production actually offshore, is that correct?
No, that's right. So we have an interest in the Ceres gas field offshore, and we also have two quite important licences to the company off the North Yorkshire coast as well.
Yeah. Talk to us a little bit more about what it is Egdon is trying to provide, because being a company as you are, as I said, mostly on exploration, we'll see in a moment on the share price in terms of what is being priced in. But what are you hoping to achieve?
Well, I think what we're hoping to achieve is a balance between our conventional business and our unconventional business. As a company, we're one of only two listed entities in the UK that have exposure to shale gas and the huge potential value that could bring. But we recognise the risks around delivering on that at the current time. And so our conventional business provides that background with quite significant potential within that. So in the coming year, we're looking to drill 3 wells, which expose the company to 11 million barrels of net resources to the company. Obviously, significant potential value driving from that. So we're looking to balance those two key parts of the business.
Yeah, what are your highlights today then, producing these numbers out this morning? What are you taking to shareholders in terms of what you're hoping to achieve?
Well, I think in terms of the numbers today, I think they're pretty flat on last year. So our production is in line with guidance. Our revenues are flat on the last year. Importantly, we've got a very good cash position. So there's £4.1 million in the bank there, which allows us to deliver on our strategy. We're debt free. So I think those are important takeaways from the numbers. In terms of actually the strategy going forward and what we're looking to deliver to shareholders, we're entering a more active operational phase. So in the coming period, we'll be participating in our first shale gas exploration well operated by iGas in the East Midlands at Springs Road. That is a key well for us in delivering on our strategy of de-risking one of our core areas in the Gainsborough Trough. I mean, over the last few years, we have delivered on behalf of shareholders a very significant increase in our acreage exposure and resource exposure within those plays. So 51 trillion cubic feet of gas, 205,000 acres, increases of approaching 200 and 300% respectively. So we've delivered on that exposure. Now it's about de-risking those plays. And it's not just us that will be de-risking those. There's a lot of activity generally in the space. So people will have seen very positive news coming out from Quadrilla recently up in the Lancashire area, where at Preston New Road they've just completed the first horizontal shale gas well. They reported earlier this year very positive results from the vertical wells in terms of gas content and the nature of those rocks. So we also benefit from general activity across that space. And I think what we should expect to see in this coming year is more of a spotlight in terms of the value delivery in those spaces.
Yeah, you said you have no debt on the balance sheet. Clearly, your operations this year are going to cost some money. Do you have the cash you've got on the balance sheet at the moment? Is that enough to do what you plan to do in 2018?
It is, because our strategy has always been, ideally, to let other people pay to de-risk some of these plays. So, for example, in shale, we're fully carried through the Springs Road well. So Ineos Shale have just taken Total's interest in those plays, and they will be paying for that well, which will de-risk that activity. In terms of our conventional drilling, so we are looking this year at stepping up our activity levels, with drilling at Biscathorpe, at North Kelsey in the East Midlands, at Holmwood down in Surrey. We carried through 2 of those 3 wells in terms of our cash position. So we're always managing a financial and technical risk through farm out.
Yeah, the process of doing what you're doing doesn't come without risks, and one of the risks is the fact you don't get planning permission, or in the case of Lincolnshire, I think it's been deferred, hasn't it, planning permission to drill. What do you feel you're up against here against local authorities and their wills, their wishes for local people?
Well, local authorities have to follow their own planning law and their own local plans, and so everything that we're putting forward is compliant with that. We generally get a recommendation for approval from the professional planning officers. It then enters the political realm, and you can understand that with a lot of pressure, particularly around sites that are involved with shale and fracking, a lot of local pressure, that those members are reluctant to make those positive decisions. But we do see that happening, and we do see those things overturned generally within this space when we go to appeal. Now, I suppose from our perspective, we were very disappointed by the outcome of the Wrestle appeals earlier this year. There were very limited technical reasons why that was refused, and we are in the process of addressing those with a new planning application. So we have taken the opportunity since those decisions in January to go back to the site, to acquire some more data, to address those specific issues, to get more geotechnical information, some deep core boreholes, and we'll be coming forward with a planning application there that addresses all of those issues in the refusal.
Yeah, we hear a lot in the States about how successful the shale business is there, and that they're contributing a lot to the domestic oil and gas supplies. Do you see realistically, ultimately, the UK being able to do the same sort of thing here for the domestic gas and oil supply? I mean, there's a very different dynamic going on here, as you've alluded to, the fact that we are a very crowded nation compared to the States. And in the States, they're operating in areas where there's a very far and wide disbursement of a relatively small population in some areas. Over here, it's so much more concentrated. The social impact of this, as you have alluded to, is immense.
Well, I wouldn't necessarily accept that premise. There are parts of the US, for example, that have very similar densities of population to what we have here, so parts of Pennsylvania, for example. Right. However, the scale in the US is obviously a different scale. But I think the key thing is that we're not looking at industrialisation of the countryside here. We're looking at a different way of developing these plays. We're looking at pads with multiple wells from those pads, so a very small land take. And actually, once those drilling rigs have gone away, virtually no impact locally. Now, if you look at industrialisation of the countryside, what about solar farms? They take up huge amounts of land for the amount of energy they produce. Now, we understand that there is a very strong and vocal opposition to oil and gas in general, the keep it in the ground movement, and I think shale gas and the anti-fracking movement is a part of that. It needs to be addressed, and I think the best way to address it is by actually demonstrating that this can be done safely with minimal impact to the local environment and the local communities, and that indeed it can generate very substantial benefits both locally and nationally. So at a local level, you're generating jobs, you're putting money into that local economy, you are improving the lives of those people, as long as you can, you can demonstrate on the environmental side. At a national level, we're offsetting the significant amount of oil and gas that we import now as a nation. I think we'll have seen recently that with the poor weather we had in the early part of this year and some of the gas spikes that we saw, the reliance on importation of gas. I mean, we had an LNG shipment in from Russia, for example. Now, with the current political climate, that's not necessarily a very comfortable place for the UK to be. Shale gas and onshore UK oil and gas in general has an opportunity to fill some of that importation.
And it's economic? Is the delivery of oil and gas using that method here in the UK economic? Well,
it clearly still needs to be demonstrated. The key parts of that are more technical, I think. So the gas price generally is a lot higher in the UK and Europe than it is in the US. The scale, it doesn't need to be at the same scale as it is in the US to make a significant difference. We would expect to see costs come down as things are scaled up, and indeed the models that we have show it to be economic. So yes, is the short answer to that.
You mentioned Total and the success you've had in bringing on partners. I want to bring up the share price if I can, because I think this is well demonstrated if we look back at this. And we look back at this spike, as I think is the Total, when Total came in on the business. That's right, isn't it?
That's correct.
That was what, back in the back end, beginning of 2014, back into 2013.
That's correct, yeah. So I think that gives you a demonstration of the impact of some success in the shale space. I think what we've seen subsequent to that in terms of our share price is obviously delays in planning and activity in and around shale. We're just getting to that point now where we're about to start, from Egdon's perspective, drilling of our own at Springs Road, and we would hope to see some positive impacts from that and other activity in terms of starting to build some value back into our share price for our very substantial unconventional resource asset base.
Yeah, one of the other headlines recently is 3i Infrastructure has now had a notifiable 15+% interest in the business. First of all, how did they come across this? And two, what do you think they're intending to do with it? Have they communicated with you their intentions?
We've had some communication with them. I obviously can't expand on that in detail today, but their interest was picked up through their acquisition of Alkane Energy. Egdon acquired the shale interests of Alkane Energy back in 2014, and as part of that it was done as a share-based transaction, and they are one of our major shareholders.
Just very briefly, and not necessarily bring the share price up again, but what are you telling investors at 5.8 pence a share? What are you telling investors about where you're going this year? You've outlined what your plans are for 2018. Where do you hope the share price to be in a true reflection of the business as you see it?
Well, I can't comment on the absolute share price, but I think my comment would be that if you look at our share price drift over the last year or so, it's largely been driven by delays in planning, issues about timing. Fundamentally, the underlying assets of the business are very sound. The onshore UK is a very profitable area for conventional oil and gas, and we hope to replicate that in terms of unconventional oil and gas, shale gas. So we would hope to see, as we move through, gaining consent for Wrestle development, Serra's gas production boosting us by 145 barrels of oil a day later in this year, as we drill through Biscathorpe, North Kelsey, Holmwood, Springs Road. We'd hope to see some of that value recognised in our share price in the coming months.
Okay, all right. Well, we look forward to catching up with you perhaps maybe a little bit later on in the year to assess the success of your plans. But Mark, in the meantime, thanks indeed for joining us. Mark Abbott is the Managing Director of Egdon Resources. Subscribe to IG for educational content, company insight, financial analysis and expert commentary.